This year, the Chamber really stepped up its active advocacy for balanced and practical regulatory frameworks for stablecoins. In November, we submitted an extensive letter to the President's Working Group on Financial Markets with our policy recommendations ahead of their report, highlighting how stablecoins are enabling a payment transition to faster, lower-cost payments, as well as the opportunity for greater financial inclusion. I'm delighted to welcome our next panel of legislative, regulatory, and industry experts to discuss what state and federal policymakers need to consider when creating legislative and regulatory proposals for stablecoins. Please welcome our moderator, Stephen Palley, partner at Anderson Kill, who will introduce the panel.
Good morning, everyone. Oh, that microphone is loud. My name is Steve Palley. I'm a partner at Anderson Kill in Washington, D.C., where I chair the firm's crypto practice. I'm absolutely delighted to be up on stage with this incredible panel of folks to talk about stablecoins, which have very much been in the news in the last couple of weeks. So hopefully, none of you are holders of UST or Luna, but I think news of that collapse has very squarely placed the concept of stablecoins in the public consciousness. I'd like to give my panelists a chance to introduce themselves, and we'll go from left to right. Go ahead, Jason.
Yeah, so I'm Jason Somensatto. I am the acting director of LabCFTC at the Commodity Futures Trading Commission. I've been there about a year, and before then I actually worked as a senior lawyer in the digital asset industry and was a lawyer in private practice. And at the CFTC, I mainly lead a lot of our regulatory outreach related to crypto, both with the Hill and the digital asset EO from the administration.
Hi, Paul Balzano. I'm a staff member at the House Committee on Agriculture. I've been there 8 years. Before that, I've spent my career on the Hill. I was on a couple of personal offices. I handle the derivatives portfolio and the crypto portfolio and a few other things for the committee.
Good morning. My name is Paul Wong. I am with the Stellar Development Foundation on their product team working on CBDC and institutions. Many of you may know me from my time at the Federal Reserve Board and the Bank for International Settlements, where I spent 17 years.
Hey there, Caitlin Long, founder and CEO of Custodia Bank.
Well, let's start broad, and maybe we can go more narrow. I guess sort of as a beginning question, we'll start with you, Caitlin. The question that I have and that I've been struggling with is the concept of stablecoins and whether they are an innovation or whether they are old wine in new bottles. And by stablecoin, I'm referring to both fully reserved cash-backed stablecoins, over-collateralized stablecoins like DAI, and so-called algorithmic stablecoins like UST. What do you think?
They are a technology innovation, for sure, but certain versions of them are just the same old alchemy, financial alchemy, dressed up in a new costume. And specifically what I'm alluding to is they certainly are a different way to issue a US dollar. The database technology is different, and they can be traded peer-to-peer in a way that only physical cash can, but they are not truly crypto in the sense that anything that touches the US dollar, so I'm talking about any sort of backed version of a stablecoin, anything that touches the US dollar ultimately has to clear through the Federal Reserve, and therefore they're not decentralized.
When you say they're not really crypto, what do you mean by that? Let's unpack that a little bit.
They may be issued on blockchain-like rails, but they are not decentralized. They have an issuer, and anything that has an issuer, by my definition, isn't decentralized. Ergo, it is quasi-crypto, but not actually crypto.
Let's go next to Paul Wong. Talk about that. What's your view? Is there technical innovation in the concept of a stablecoin? And I guess as a follow-up question about that, if so, is this innovation that requires new regulatory or legal innovation to match it? What do you think?
So stablecoins are a different form of money, and money has existed for centuries. What stablecoins do is they serve as a store of value, they serve as a payment instrument, and a unit of exchange. So there is nothing new here except for the technology. And the technology, as Caitlin noted, is exciting. It's about making transactions faster, cheaper, and it also opens access. Does stablecoins require new regulation? I'm not so sure. I think what stablecoins have really highlighted for all of us is that there's a gap in the existing legal and regulatory framework for payments and financial instruments.
Where is the gap? When you say there's a gap, what do you mean?
The gap is that we're all here today talking about regulating this particular instrument. And there's the gap. We don't know how to do it. It's not clear that regulatory authorities have the power to do it.
Paul Balzano, I want to come back to you, but Jason Somensatto, I know that you're speaking on your own behalf, not on behalf of the CFTC, but you are with the regulator. I guess my question for you, what's your own personal view? Do you think that there is a gap in existing law, or do you think that the laws that we have on the books suffice?
So not only would I disclaim my views on behalf of the CFTC, but also the OCC, the Fed, pick any regulator you want out there but I think that's important because I think ultimately, as with a lot of things in this sector, the regulatory issues aren't just one. It's not just how do you regulate stablecoins and is there a gap in there, right? I think what the President's Working Group report reflected was, at least with respect to the idea that stablecoins are going to be payment instruments in the kind of broader economy, that in that context, the prudential regulators saw a gap in terms of bringing that within a prudential regulatory authority. I think then there could be a separate question, right, as to these assets. I think one of the things that makes them unique is the kind of open market trading that happens, right? And as a market regulator, that's where I focus a lot of my attention and time. And so in that open market trading, we only have 2 market regulators in the US, and so if it's not falling under a securities regime, then it kind of generally falls outside of a spot regulatory regime. And so, whereas, for example, and this gets really deep into the details of the CFTC's authority, we do have some level of authority over Forex trading, but this wouldn't fall in that category. So when I think about gaps, I think about it from a lot of different perspectives, right? I have calls with other regulators, and so I think, the FDIC would say, yeah, there's a gap here in terms of how are we going to address this from an insurance perspective. The Fed might say a separate gap, and then the market regulator is a different one. So I think it's not as clear as is there one gap, but I think what the PWG report probably identified is that at least within that stablecoin payment instrument thing, there is a prudential regulation hurdle that it needs to be overcome that looking to Congress to potentially address.
Paul Balzano, last but definitely not least, I know you've been working on this issue very closely in your role with House Ag. What's your view, generally speaking? And of course, again, speaking for yourself, not speaking on behalf of anyone else. Old wine in new bottles, or something new here that requires new legislation?
So I think Caitlin actually described it pretty well. The technology, I think, is certainly interesting, right? The ability to transfer value between people electronically without an intermediary is exciting, right? And that's different. But certainly, I think the whole history of crypto, right, has been a long series of people sometimes repeating past mistakes. And I certainly think you see that here. But then the challenge with stablecoins, too, is there's so many different kinds, right? You've got a broad spectrum from asset-backed stablecoins to algorithmic stablecoins and sort of everything in between. And trying to figure out which one of those things is useful and unique and new and different is, I think, a little bit more difficult.
Let's talk a little bit more about sort of the distinction between the types of stablecoins that exist. Does somebody want to address that? Sort of give our audience an overview of the difference between a fully backed stablecoin, a collateralized stablecoin, and an algorithmic stablecoin? Go ahead, Caitlin.
Oh gosh, okay. I was.
Oh, I thought you were volunteering.
No. Happy to. There are basically three groups. One is a fiat collateralized stablecoin, which is backed by assets that, in theory, should be liquidatable if there's a run on the stablecoin. Although there's a huge question about that because we saw Terra Luna collapse within the span of hours, and none of the assets that are currently backing US dollar stablecoins can be liquidated that fast. Every single one of them, even T-bills, can't be liquidated until the next day. And that is an enormous risk for the banking system involvement in crypto. We can come back and talk about that. But then there are crypto-backed stablecoins, and then there are algorithmic stablecoins that have some sort of a mechanism by which they're supposed to be stable. That was what Terra Luna was. As we saw, there was a hyperinflation. I think it was something like 7 million% hyperinflation at the end. The market hasn't learned because there's a new version that's quite similar to Terra Luna that was introduced right after Terra Luna, and it's already up to 500 million in assets I saw yesterday. It's too bad.
Paul Wong, what are your thoughts on these three types of stablecoins?
So I think you asked a really important question, which is how do we define stablecoins? And I think from my perspective, algorithmic-backed assets are not stablecoins. They are not very good payment instruments. I think as Caitlin noted, it is not clear they're actually backed per se. So in the conversations around stablecoins, we really need to be careful in terms of how we define it, how we use it. I think we've broadly used stablecoins to label a bunch of assets that are not actually stable.
They're CDOs.
They're what?
The algorithmic stablecoins are the latest version of CDOs.
Okay.
The instrument that blew up the financial system in 2008.
Well, what do the rest of you think about that? Paul Balzano, do you think that these things are, the algorithmic stablecoins should be treated like CDOs?
Well, I mean, I think to Paul's point, right, like to the extent they're not stable, it's hard to call them stablecoins, right? They're just, if they're not useful and they're not going to remain stable, then who's going to use them and why? And I think that's a real challenge as we think about how to regulate them.
I suppose it begs the question, however, of the role of regulators in protecting consumers on the one hand and stifling innovation on the other hand. Jason, can you speak to that? The role, I guess my question is, we can see that there's something dangerous about a purely algorithmic stablecoin where you have basically two different types of cryptocurrency created from the head of Athena, basically, created out of thin air, where the value of one is tied to the value of the other. In the case of UST and Luna, I think it's going to take some time before we fully understand what happened. Some people have said it was attacked in the way that George Soros attacked the British pound. Some people have suggested that the use of yield product on Anchor basically led to a bank run, that there was no fundamental utility. But then the question is there something interesting there nonetheless? And what is a regulator's role in, on the one hand, allowing for that interesting thing, and on the other hand, protecting markets and protecting consumers? I think I just asked 10 questions in that one question.
So I will answer then none of them and just go in my own direction.
Yeah,
no, I guess the way I like to approach it from like a regulatory perspective is to try to strip away some of the technology, right? And say like, what do you have when you're holding on to a stable coin? And I think with the models that have a central issuer that's basically promising redemption at par, right? It's probably a little bit easier to slot that into traditional legal thinking, right? And I would say in some ways, I think a lot of discussion gets talked about like collateralized versus uncollateralized algorithms, but it's really from the customer's perspective, right? What do I have in my hand that I can do with? And if there's a company out there that's promising to give you dollars, regardless of whatever rate this trades at, then I think that's a regulatory bucket that you can kind of deal with and address on that level. With, whether it's algorithmic stablecoins or decentralized or whatever term you want to use, When you don't have that dynamic, what do you have? You have something in your hand that you presume a computer program is going to distribute something else of value back to it when you go to it, right? And will that value be, some collateral held in a smart contract? Will that be printing of new tokens out of this system? I don't know, but I think about it from a regulatory perspective of what do you want that customer holding that asset to know, right? They want to know, is this going to work? Right? Is the mechanism that's going to pay out going to make me whole? And one of the tricky things I think is it becomes the marketing outside of the thing. Everybody say, oh, look at the code, this is exactly what happens. But I would presume for the people who held a token, and hold lots of stablecoins, the assumption is this thing is worth $1, right? And what do we need consumers and investors to understand as to, is it really a claim on $1 or is it a claim on, a printing of a new token? And so I think that kind of creates a natural regulatory divide a little bit as to whether you have an entity there that's kind of promising that redemption. And then I think, and that is just from the investor customer protection regulatory start, right? I think, using the term CDOs makes a regulator flinch up because the idea of financial stability becomes incredibly important, right? As into how integrated these become into the traditional financial system. And I think that's probably going to be a balance between where we go from a regulated perspective, but also, does somebody actually want to hold a token that might not work in that way and might go to zero in 24 hours.
Paul Balzano, your thoughts?
On what? Yeah, I can't say it much better than that, Jason. I think from the congressional perspective, right, I think it's similar from the regulatory perspective. We have constituents, and we're trying to think about how do we create regimes that protect people, but it's hard to figure out the right way in which you can look at a stablecoin and an algorithmic stablecoin and think about how do we regulate that? How do we put rules in place that a regulator can implement for us to protect customers?
Well, here's a question that I have. We can obviously see the problems and the risk that these things create. Somebody, I can't remember who said this, the connection to yield products sort of begs the question of, where does the yield come from? Someone wiser than me I heard say recently, if you don't know where the yield comes from, you are the yield, which I think is, guaranteed 20%. Bernie Madoff somewhere is looking down and smiling.
The new one's offering 60%.
Yeah,
Yeah.
It's crazy. Well, the question I have is, is there signal in the noise? What do you think, Paul Wong? And maybe you could talk a little bit about the work you do at Stellar and sort of Stellar's view of stablecoins and algorithmic stablecoins. What's the innovation? Is there one, or is this a flash in the pan, and should we be regulating them out of existence?
So stablecoins, I think, as we've heard today, serve a really important function. Within the Stellar network, we have 20 operational or planned fiat-based assets on the network. Those assets cover currencies supporting more than 50% of global GDP. And that's a really impressive number. And the reason why I wanted to share that is because stablecoins serve a functional value. And they're important. I think Perry Ann spoke to the benefits of stablecoins earlier, the benefits of digital assets. So there is a lot of potential in this space. We just need to realize that potential.
Is there, I've heard, was at a lunch recently where someone spent quite a bit of time talking about stablecoins, the use of stablecoins, providing the ability to bank the unbanked. What do you think of that, Caitlin? Do you think that that's, is that just savvy? Is that savvy marketing, or is there something there?
Well, maybe, but the unbanked have to have cell phones and understand how to use the wallet infrastructure. They're getting there on their own. We're seeing that, of course, with Bitcoin and the Lightning Network, where we really are seeing unbanked people starting to get access to financial services in the world that have not. But vis-a-vis the US dollar, I think it's different because, again, these are issued by banks. The Fed controls the US dollar, and And anything that's an actual US dollar as opposed to a derivative that's trying to track the US dollar is going to come inside the banking system. And the biggest reason why there are so many unbanked has to do with know your customer, anti-money laundering type rules, where some folks who don't even have identification can't qualify to get access to a bank account.
So does this mean, like if we fast forward 5 or 10 years, the concept of a fiat-backed stablecoin will go away, and we'll be talking instead about CBDC? No? Well, what do you, Paul Balzano, what do you think? 'Cause it seems to me that the issue, one of the problems that Bitcoin set out to solve was how to send money on the internet, right? It's solving the double spend problem. Now, I think we can all agree that micropayments haven't really worked yet. Maybe they work on Lightning. But if the issue is basically creating a cash equivalent, in the end, is this going to be something that states are going to take over? Are we going to see CBDC supplant private fiat-backed stablecoins?
Yeah.
I'm asking you to predict the future.
Hard to
So
predict
it's a
the
risky
future, right?
proposition.
I've heard folks speak very eloquently about CBDCs and the importance and the future that they have. I've heard folks speak relatively hostile to CBDCs and the current concerns about the government and sort of infringement on privacy and the like. I suspect that we're gonna wind up in a place where we may have both. And you have a CBDC that the federal government runs and operates, but then people also operate stablecoins on the side that maybe work slightly differently or offer different services or work in coordination with a CBDC, right? That feels like a future that folks here are probably trying to build.
Jason Somensatto, again, speaking for yourself. Do you think a CBDC, a central bank digital currency in the United States, can coexist with fiat-backed stablecoins?
Yeah, that's hard. I guess, I don't know if I can answer that. What I think, from my perspective, like one of the reasons I joined the government is because I think that marrying of private sector payments, financial market infrastructure, necessarily always involves the government, right? And that sounds kind of antithetical probably to some people in this crowd, but like, I think you see this in a lot of existing structures, right? And I'm not a payments expert by any means, but knowing about, some of the payment networks that connect institutions right now, right? There is a layer of private market participation, and then there's a layer of government regulation integration. Similarly, in the CFTC's markets, I think that's also very true, right? We designate contract markets, we register these entities, and at least I, for one, think there's a lot of good policy reasons for that. And so when I think about, when we're talking about disrupting money, the idea that the entire money supply and structure is going to be managed outside of the government process seems unworkable to me. On the flip side, I also get the idea that people might not want, all of payment infrastructure to be managed by, a team of bureaucrats like me. But I think so necessarily how that, the CBDC line and the stablecoin for payments things intersects and come together, that's what all the venture capitalists putting a ton of money into this space presumably have views on, but I don't.
This might be a good time, Paul, for Paul Balzano. One of the requirements to be on this panel is to have the name Paul or a name similar to Paul. Some of us failed, but we're still up here. I'd love to hear about, I'm sure the audience would love to hear about your work on the House Ag Committee and the bill that you've been working on. What are the problems that you're trying to solve? And give us sort of a high-level, 1,000-foot view of some of the key components of that bill.
Yeah, happy to. So the House Committee on Agriculture oversees the Commodity Futures Trading Commission, which is why I get to be involved in crypto. And I think there's a few problems that I think we've seen over the last few years that we've been trying to solve for. I think first and foremost, there's a gap in the sort of the spot market regulation of exchanges. So we create a new regulatory regime at the CFTC to give them oversight over spot market exchanges. I think the second question that needs to be solved at the same time is sort of how do you identify what what assets are what we've termed digital commodities and eligible to be traded on a spot market exchange, and what are securities and remain in the world of the SEC's oversight. And so we've tried to bring some clarity and order into that process. And then we also have a section on stablecoins, sort of a regulatory regime for very plain vanilla stablecoins that.
What's a plain vanilla stablecoin?
Yeah. So sure, an asset-backed stablecoin where the reserves are held in cash or high-quality liquid assets, and that's there are risks, I think, that were identified in the President's Working Group. And some of those risks look very similar to the risks we face in commodity markets with clearinghouses and FCMs, right? We have a question in the FCM about where customer assets are and who holds them, and do we have sufficient customer assets to match the FCM's obligations? And then at clearinghouses, we have a similar problem that Caitlin identified with respect to liquidity and the need to have assets on reserve and available in a moment of emergency. And I think we can sort of marry some of those concepts and come up with a regulatory regime for stablecoins that provides oversight and provides a framework in which people can trust that the assets that are promised are there and that they are held in such a manner that when needed they are available.
Caitlin, you're CEO of a bank, right?
Yes.
So, and you, I believe you received the first Wyoming special purpose depository, second. Mm-hmm. So very, very much at the forefront of innovation in the space. What's your view of the role of banks in connection with stablecoins, either issuance or facilitating transfer?
Well, for one thing, I disagreed with the President's Working Group's recommendation to have insured depository institutions issue these. Being in the weeds of how the payment systems actually work, that would be a disaster for the insured depository institutions, because the moment there's a run on one of the stablecoins, it actually does become contagion into the insured system, which would ultimately create the financial stability risks that the regulators are trying to avoid. And the good news is, I think, I've spoken to some of the folks involved, they realize this now. It was interesting because Dr. Manmohan Singh and I of the IMF have for years collaborated on plumbing issues in the capital markets and payment systems. And we submitted a piece to risk.net about a month ago that laid out the 3 different options, whether it be insured depository institutions or banks that issue them backed by cash on deposit at the Fed, or banks that issue them backed by T-bills and other high-quality liquid assets. And risk.net came back to us and said, cut out that first one. Everyone understands now we don't want insured depository institutions to be issuing these, and focus on the second 2. And we ended up explaining, due to the liquidity risks, because of the settlement mechanics of T-bills, it's dangerous even to have T-bill-backed stablecoins, because T-bills settle next day, and you could have a run in the span of hours, and that could very easily turn into contagion for the financial system. So we've been consistent really all along, saying it needs to be a special purpose bank charter that has direct access to the Fed. Why a bank instead of a non-bank? It's because you have to be a depository institution under the Federal Reserve Act to be able to bank at the Fed. That's been established for decades, and I suppose Congress could change that if it wanted to, but I don't think the Fed would want that. Why? Because it doesn't want the credit risk of facing a non-bank. Banks are examined once a year, non-banks maybe once every 3 years. Banks have higher Bank Secrecy Act, AML, CFT standards than non-banks do, and banks are far better capitalized than non-banks. And so I think the Fed would fight that tooth and nail, changing the access to the Fed to include non-banks. And so what Wyoming did, and here's where I would disagree with some of the comments earlier in the panel, what Wyoming did was we understood all this literally 4 years ago and set up a special purpose bank charter. We were definitely ahead of our time. And the whole idea was, how do you, in the weeds of the settlement mechanics, to make sure that you don't touch off a bank run in the traditional financial system, which is very geared, the liquidity provision is very geared, as Paul knows from his time at the Fed, very geared towards the term structure of the liabilities of banks. How often do people all go and withdraw their deposits at the same time? FedWire settles in hours, ACH settles in days. We're talking now about stablecoins settling in minutes. That's going to change the liquidity needs of the financial system if the banks get involved. And so you have to have a particular type of bank that ring fences this risk so it doesn't end up spilling into the capital markets or to the insured depository system, but it needs access to the Fed, which already has real-time payment capabilities and real-time monitoring capabilities. That's the obvious answer, and it's been something that we've been talking about for years. It's very interesting to see the bank regulators come to where Wyoming was. I think in the beginning everyone said, oh, Pshaw, isn't that cute? It's a small state. In some corners it was, oh, it's a red state, although the Democrats are the ones who are in Wyoming in charge of the effort now. And so the world is definitely moving to where Wyoming was. And so I would posit there is no regulatory gap. The Fed has had the ability to approve this for 19 months, and it hasn't. And so the fact that a lot of people lost a lot of money in Terra Luna, I would posit what would have happened if the Fed had approved a bank to issue a digital dollar 19 months ago. The market would be a lot different, and you would not have had so many people be scammed.
Anyone, in spite of the applause, does anybody want to take a contrary position? Okay. Sort of a big picture question. We saw things like the Securities Act of 1933, the Exchange Act of 1934, the 40 Acts arise out of the ashes of the Great Depression, but they had been preceded by things like the Martin Act in New York. But what they did was they responded to the particular needs of that time, the need for greater disclosure. Some of the pushback at the time, if you read about the history of these statutes, was the notion that investors weren't actually going to read these reports. It was basically for show and for theater. I'm wondering if, nonetheless, we're at an inflection point like we were in 1933 and 1934. Do we need a new regulator? Do we need a regulator focused maybe not just on stablecoins, but on crypto in general? Is there something about this technology which creates a set of risks that are different than those addressed by, say, the disclosure requirements under the Exchange Act? Why don't we start with, I don't think we've heard from Paul Balzano just yet, so go ahead. The floor is yours.
I don't think we need a new regulator. I think between the SEC and CFTC we have adequate authority and sufficient, very smart people who can address the markets, and certainly at the SEC, if you are engaged in fundraising, there should be a disclosure regime. And I think the way we've looked at it, if you are raising funds, that is an SEC-regulated activity. The token that's created, we have a definition of digital commodity. If it meets that definition, then it is a commodity, full stop. And then we trip over into a regulatory regime run by the CFTC.
What do you think, Paul Wong? I mean, I guess to be even more specific about it, the risks associated with stablecoin technology, for example, I guess my question is, are they more software risks than they are risks that are addressed by a disclosure regime? And if so, are our regulators equipped to address technology risk, which I think is probably broader than sort of financial disclosure risk?
Thanks, Stephen. I think it's important to note that from my perspective, we should be regulating activity and not technology. Whatever regulations that we produce should be technology agnostic, so we should be regulating activity, whether it's for payments, it's for investment, or for some other purpose. Do we need a new regulator to do that? I think in the last panel, or in the last few panels, someone noted that the US has more regulators than anywhere else in the world, and that's probably true. So do we want to add another one? I leave that up to Congress.
What do you think, Jason? Does the CFTC, the right, or the SEC, are they the right regulators to address pure technology risk?
I kind of agree with my earlier panelists. I think there's a few different ways to attack this, right? One is like, what is the risk we're talking about, right? Are we talking about a market level risk? Are we talking about a payment structure risk? In those traditional areas, I think, there are existing regulators that are equipped to manage that. There's Congress to step in when they think they need new authorities or different authorities. I would kind of just make this side comment of like, are you guys all dying to join a regulator focused on crypto? You know, we have enough trouble probably bringing in the talent to think about some of these issues as it is. So in that, that capacity, I think, we have what's already in place is, covers these risks. It's focused on these risks. To the extent that you present a new risk, like a technology level risk, I still don't think that, leads you to the conclusion that you want a new regulator. It's interesting, from a markets regulator perspective, there's and people probably don't realize this, there's a very heavy reliance on self-regulation, right? Is that the exchanges themselves are regulators in these market systems. And they actually do a lot of the surveillance, a lot of the cybersecurity, and as the oversight agency, we're making sure that the people in the industry are the ones who are thinking through those considerations and whatnot. And I'm not sure people want to give that authority to the government to be like, no, you design my cybersecurity system to make sure it's all safe and whatnot. And I think that's probably equally true for crypto, right? Which is so you're going to defer how you structure these products to the government because you think we'll have a better sense on security in a specialized agency. I don't know, it just doesn't really kind of logically fit up with the way that I think the regulatory structure is in place, particularly from, and again, I'm biased, I come at it from a market regulator perspective.
So you mentioned self-regulation. Do we think that there is a place for formal self-regulation for something like an SRO for stablecoin issuers, or is that something that's unnecessary? You're shaking your head, so I'll let you answer, Caitlin.
Yeah, I don't think so, because again, it all comes back to what is a stablecoin? The stablecoin is trying to actually be redeemable for a US dollar or the equivalent amount thereof. And so that's touching the banking system. A US dollar is a fiat currency that's issued by a central bank and the banks that are licensed to issue dollars. And a self-regulatory organization is not going to be able to get access to that. And again, it comes back to, if you buy the conclusion that even high-quality liquid assets don't settle fast enough, and in order to truly ring-fence the risk, there's one and only one type of backing for stablecoins that truly ring-fences the risk, and that's cash on deposit at the Fed. Now we're back to, okay, who gets access to Fed master accounts? And I'm in the middle of that, and we're 19 months and counting, and I'll show a little legs, so to speak. The state of Wyoming, when the structure of the Wyoming Special Purpose Depository Institution was proposed in 2018, there was a provision in the initial draft of the bill that required the Attorney General of Wyoming to sue the Fed if the Fed did not grant master accounts to validly chartered Wyoming Special Purpose Depository institutions. And I was not privy to this phone call, but the Fed called the state of Wyoming and asked for that provision to be removed from the draft bill. And there was a gentleman's agreement that was made at the time to remove that provision from the draft bill. The reason is that the Fed had said they had just litigated that issue. It had been appealed up to the appellate court in the 10th Circuit, and they lost, and they didn't want to litigate it again. And they said, we will work with the state of Wyoming. Senator Lummis alluded to this in her Wall Street Journal editorial. There were hundreds of meetings between the Federal Reserve and the state of Wyoming. Wyoming did not do this in a vacuum. And then when somebody actually got chartered and applied, the door got slammed shut. So either the door is going to be reopened in a friendly way, or maybe this doesn't end so friendly.
So one of the things about crypto in general and stablecoins in particular that's interesting to me is sort of a move from a cashless, from a tangible physical cash economy, where you have a certain amount of financial privacy, to a fully digital economy. In addition to, I happen to think that dollars smell good. There's something comforting about them. Maybe it's because I'm old, I don't know. But it feels to me like the emphasis on regulation, I think we probably all agree that paper money is going away. It may not be this year, it may not be in 10 years, but eventually we're not going to have it. Should there be a space that regulators leave alone in the United States so that people can transact privately, just like they do with $10? Maybe I don't want the fact that I paid $25 to have somebody cut my grass. Maybe I don't want a surveillance regime to be recording that. How, and I'll ask each of you to address this, how should the law adapt to this? Or is it inevitable that our financial surveillance regime, which began in the early 1970s with really a focus on organized crime and has now become this massive sort of octopus with tentacles everywhere, is there a way that we can prevent those tentacles from entering into every aspect of our personal and financial lives? Or are we going to have to give up a certain amount of freedom in exchange for safety or security? Why don't we start with you, Jason? Easy question.
Yeah.
I'm giving you a soapbox.
Yeah, right. I'm not sure this is the soapbox that I jump up on. Like, I think there is, I guess I come at it from a slightly different angle, which is I interpret a lot of the development in this sector to be geared towards trying to allow for private peer-to-peer transactions that aren't, are kind of fall outside of using intermediaries that might be surveilling that ecosystem, right? And so in that context, I think there can be a misinterpretation of like regulators' desires of like, no, that's fine, you can, have a peer-to-peer transaction. Now, if some illegal activity is occurring, right, of course, a regulator whose jurisdiction is to see that is going to try to identify that activity. I think what is unique is in the fervor or the excitement around this, a lot of people are interjecting new intermediaries, right? And so when you do that, the regulatory structure isn't going to just constantly reassess. Okay, well, we want to allow private, so we're going to allow you to, trade on a centralized exchange without anybody looking at it. Instead, it's going to say, no, same rules, same activity apply. And so in some ways, it's a little bit of a reflection of where the market's going, right? The market, at least from my perspective, there's this drive to speculate on a lot of these assets that allow people to say, I don't really want to hold them into a peer-to-peer transaction. I want to get price exposure to them. And I think one of the fundamental questions I'm always thinking about when people come in to talk to LabCFTC is, are you talking about using cryptocurrency for the underlying technology rails, or are you talking about price exposure to the cryptocurrency? And honestly, as a market regulator, I'm more focused on this side, but I would say 95% of people fall into that. So I don't know, it's not a view on what the government should do. I leave that to Congress and to broader considerations than just my own. But I kind of try to take the world for what it is, and that's what's being presented to me as a regulator.
Right, now you get to speak for Congress, Balzano.
Sure, yeah.
I guess the question is, should there be should there be a safe space from a regulatory standpoint for people to transact using cryptocurrency stablecoins privately without having to worry about FinCEN, the Bank Secrecy Act, and so forth, or is that going to be gone in the future?
So certainly, I think there should be. I think the question is, how do you do it? And I think that's the really hard part. And I assume everyone here would agree that there are, they would prefer that their financial life have a measure of privacy to it. I think most people in Congress would probably prefer the same thing as well. I think the challenge is, how do you do that in a way that preserves maybe a small safe space, but doesn't, open the door for all the sorts of illicit financing and terrible things that people can do with money, allow them to walk through the same door. And that's a technical challenge, and I don't know how to solve it, but that's a thing I think we do need to think about. It's a real challenge, but we certainly should have privacy. I think that's important. Obviously, we don't want to extend privacy to everyone who's acting badly.
Paul Wong, you've got about 30 seconds, and then Caitlin, I'll let you have the last word.
I'll be quick. One of the things I've learned from my engineering teams is technology can do whatever we want it to do. We just need guidance. So if privacy is really important to US society, we can build it in. If it's not important, it makes life easier. But technology can do whatever we want it to do.
And I would say anything that touches the actual US dollar or has a centralized issuer is not going to be able to escape those requirements. The truly decentralized parts of this sector are never going to be able to have those requirements enforced upon them. And so the regulators should focus on the place where they can actually successfully regulate. And the truly decentralized parts of this industry, I think if they try to regulate it, they'll realize how impossible it actually is.
Well, it looks like we're going to leave with about 20 seconds left. Does anyone have any final thoughts they'd like to share? All right, well, thank you very much, everyone. Thank you to the panelists.